Imagine waking up to see that some of the biggest Nigerian banks were in trouble. People feared for their savings, investor panic, and the whole banking system was on the brink of collapse. That's exactly what happened during the 2009 Nigeria banking crisis. Hi everyone, welcome to Throwback Thursday, where we review some of the biggest financial and economic events that has happened over time. And for today, we'll be looking into the 2009 Nigerian banking crisis. To understand this crisis, we need to go back a few years. So in 2004, the Central Bank of Nigeria, known as the CBN, introduced a banking capitalization exercise, which increased the minimum capital requirement from 2 billion naira to 25 billion naira to make banks more resilient and more stronger. And this reform was actually successful because in 2005, the number of banks we had in Nigeria actually reduced from 89 to 25 banks, which actually increased investors' confidence, made credits more accessible, as well as banks became more stronger and more resilient. Between 2005 and 2008, Nigeria experienced an economic boom, which was characterized by high oil prices as well as a rising stock market. And with that, banks aggressively compete to issue out loans to people, especially investors buying shares on the Nigerian Stock Exchange market, as well as companies operating in the oil and gas sectors. Many believe that this boom will continue indefinitely. So, what went wrong? The problem was that a lot of banks were actually taking on too much risk. They issued out large loans without doing adequate risk assessments. And a significant portion of this loan actually went to stockbrokers, investors that actually used shares as their collateral. Then came the 2008 global financial crisis. Foreign investors started pulling out their money out of emerging markets such as Nigeria, leading to a fall in share price. Okay, so stock prices declined sharply, and the value of shares that were actually used as collaterals also declined. So people that relied on the rising share price as a collateral could no longer use it in repaying their loans, and banks that appeared to be profitable were now struggling under a huge amount of bad loans. So, to the turning point, in 2009, the Central Bank of Nigeria, under the leadership of Lamido Sanusi, did a special examination of all banks. And the results were alarming because it showed that a whole lot of banks had severe liquidity problems, weak corporate governance, and a lot of non performing loans, that is, loans that borrowers had stopped repaying. So, to prevent the banking system from collapsing, the central bank actually took some decisive action. So, first, the CEO of eight banks, including Afribank, Intercontinental Bank, Oceanic Bank, and many more, were actually removed. And the central bank injected around 620 billion naira to protect depositors and to keep the system running. So this crisis came with a whole lot of impact because investors' confidence dropped, banks were more cautious about lending, businesses found it hard to access credit, as well as the Nigerian Stock Exchange market also experienced some downturns. This banking crisis led to some major reform. So in 2010, the government actually established the Asset Management Corporation of Nigeria, known as AMCON, to purchase some of the bad loans and help stabilize the financial system. Also, banks were required to strengthen their risk management, governance practices, as well as comply with strict regulatory standards. This reform actually played a major role in restoring confidence in the Nigerian banking sector. The 2009 Nigerian crisis actually showed that rapid growth without proper risk assessment can be dangerous. So, a bank's strength is actually not measured by how many loans it gives out, but how wisely it lends and how it can manage its risk. So, next Thursday, we'll revisit another financial and economic event that shaped the world. So, if you found this insightful, please do well to like, share, and comment. See you next Thursday.